Small business tax deductions you must absolutely know so you can stop sending free money to the IRS. Watch this video to make sure you're capitalizing on the most valuable but often overlooked deductions when doing your small business taxes. It's time to stop overpaying for taxes and to use the extra cash instead for expanding your corporate activities, hiring staff, saving for an emergency fund, or doing anything else you feel like. So stay organized, save receipts, and record every expense using an app or accounting program. Welcome back, folks, to another edition of the Awesome Sweetie Kiwi Show. How you doing today? I'm doing marvelous. If you are doing as great as I am, go grab a cup of coffee or tea or vodka and let's roll. Today we're talking about small business tax deductions you must absolutely know so you can stop sending free money to the IRS. The IRS is the last agency that needs your free money. They already have a lot of money. Okay, now note though that all these deductions can be claimed by sole proprietorship as well as C Corps and S Corps, partnerships and LLCs, although there might be different rules for each. So what I'm trying to say here is that the small business deductions I'm talking about here apply across the board. Number one, software subscription. If you've bought or downloaded software for your business, this can be deducted. Now, these types of expenses can be claimed under something called other common business expenses, other miscellaneous expenses on your Schedule C tax form, Schedule C on your Form 1040. Auto expenses. If you have a car for business purposes, you can generally deduct anything considered a car expense. Remember that, however, you need to have records that prove business utilization, as well as you need to keep track of your miles. Now, if you can't have that, if you don't have proper records, or you cannot prove the number of miles you drove during the year, you can rely on the IRS standard mileage rate, which is currently 58 cents, 0.58 cents per mile. If you use your car for both business and personal purposes, you must divide your expenses based on actual mileage. Now, the IRS has comprehensive information about this, and this is on publication 463, travel, entertainment, gift, and car expenses, and you can get more information there. 3, advertising and marketing. Now, if you can prove that this advertising and marketing expenses are related to your business, you can claim back any money spent on ordinary advertising and marketing purchases. This includes things like business cards, the Yellow Pages ads, billboards, as well as hiring a freelancer to design a business logo or sending thank you cards to clients. Number 4, business entertainment. If you are in a business where you frequently or even sporadically entertain clients with meals and events, this too can be deducted if this is necessary to your business. Remember though that meal costs are only deductible up to 50%. Certain types of meals, such as a meal provided at an office party, are 100% deductible. Be sure, and this is always important when it comes to the IRS, be sure to save your receipts and note the business purpose of the meal in order to maximize this deduction. Bad debt. So if you have ever lent money to an employee or a vendor without receiving it back, you can claim that as bad debt. Or if a client hasn't paid you, you can claim that also as bad debt. You need to be able to prove that this was business debt rather than personal debt. Now, the IRS has a very clear explanation. The IRS defines bad debt as a loss from the worthlessness of a debt that was either created or acquired in a trade or business, or closely related to your trade or business when it became partly to totally worthless. Let me repeat that. The IRS defines bad debt as a loss from the worthlessness of a debt that was either created or acquired in a trade or business, or closely related to your trade or business when it became partly to totally worthless. So in simple language, in simple English, the IRS is just trying to say that you can only deduct this bad debt if it's partially or totally related to your business, right? So the following are examples of business bad debts. So loan to clients, suppliers, distributors, and employees, credit sales to customers, or business loan guarantees. Number 6, employee gifts. Employee gifts are 100% deductible up to $25 per year per employee, according to IRS publication 463. Again, this is the same publication that relates to travel, entertainment, gifts, and car expenses. Interest. If you have a small business loan or a line of credit where you haven't repaid the full balance by the maturity date, if you make interest payments on what you're borrowing from the lender, those interest payments are usually fully tax deductible as long as the loan is used to cover business expenses. So to claim this deduction, you, the business owner, you must be legally liable for the debt, and the business owner and the lender must have a debtor-creditor relationship. In other words, the loan must be through a traditional lender and not a friend or family member. Okay, I'll be right back right after this. Don't go anywhere. Welcome back, folks, to another edition of Sweetie Kiwi. We are still talking about small business tax deductions you must absolutely know so you can stop sending free money to the IRS. Now, if you love the clarity and quality of the content so far, please consider subscribing to our channel and turn on the notification bell so we can send you more beautiful stuff, more beautiful content on a daily basis. Turn on the notification bell, comment, like, and share this content. Let's talk now about startup and organizational costs. This tax deduction comes with a caveat though, because it's not really a tax deduction. Business startup costs are seen as a capital expense by the IRS because they are an investment in your business, right? So the money hasn't actually left the business, it was just transformed into an asset. So deductions for capital expenses typically occur over several years. This is known as amortization, and this will help your business accurately assess the profitability year over year. All right. Inventory. Now, some inventory-based businesses will manufacture products or purchase them for resale. If you are in that category, you can really deduct inventory-related expenses. For example, the cost of products or raw materials, including freight, the storage, direct labor cost, right? Including, in this case, and this is important to remember, a lot of small business owners forget about this, including contributions to pensions or annuity plans for workers who produce the products. Factory overhead, everything about utility, everything about energy, water, maintenance, that's part of factory overhead. Number 10, travel expenses. If you travel for business or your staff travel for business, this is something that you can definitely deduct. For a business expense to qualify as travel though, it must be away from the city or area in which you conduct business. You must also be away from your tax home for longer than a full work day. So types of deductible travel expenses include lodging, airfare, tolls, and taxes. Taxes. Now, it's kind of funny. This might sound a little strange here, but you can actually deduct the taxes, the fiscal debts you incur from just running your business. Those are deductible. So these taxes might be federal, state, and local income, real estate, or sales taxes. So your employer taxes, such as the employer share, the 50% you pay for FICA, that's Social Security, and Medicare, FUTA, the federal unemployment taxes, and state unemployment taxes, they are also fully deductible. You can also deduct contracted labor. So if you use independent contractors or freelancers as part of your labor force, the cost of hiring contracted labor is fully 100% tax deductible. Now remember that you must issue a Form 1099 to any contract worker receiving more than $600 from you for any given tax year. So if the employee is being paid via credit card or PayPal, the payment processor must issue the worker Form 1099-K. Employee salaries. Now, in general, your employees' salaries are fully deductible. So here I'm talking about just the regular salary, but also bonuses and commissions. Now, this deduction does not apply to sole proprietors, partners, and LLC members because those individuals are not considered employees. Remember, the members, LLC members, the partners, and the sole proprietors, they have to pay their taxes. They have to, whatever company they have is considered. It's not. In other words, they're not being taxed at the company level. It's called a pass-through entity. That's where I was blanking before. So basically, an LLC, a sole proprietor, or a partnership is not considered it's considered a pass-through entity. In other words, the members and the owners of those companies are paying taxes at the personal level on Schedule K1 or Schedule C of their 1040. So they're not considered employees. So they're not paying taxes, FICA, and all the other stuff. No, but they might be paying self-employment taxes on their personal tax returns. All right. And the next expense you need to be aware of is the legal and professional fees. So if you ever need to hire a legal or accounting professionals for your business, you can deduct 100% of their fees. I'll be right back right after this. Don't go anywhere. Welcome back, folks, to another edition of Sweetie Kiwi. We are still having a conversation here about small business tax deductions you must absolutely know so you can stop sending free money to the IRS. Now, note though that all these deductions can be claimed by sole proprietorships, as well as C corporations and S corporations, partnerships, and limited liability companies, although there might be different rules for each. Utilities. Any utilities that you use for your business are fully deductible. I'm talking about the factory or in the office. Yes, this includes things like water, electricity, trash, and telephone bills. However, if you have a home office and use a landline, the cost of the first landline is not deductible, but subsequent landlines are. Let me repeat that because a lot of small business owners working from home get this wrong. So when it comes to landlines, the IRS has a very clear guideline. If you have a home office and used a landline, the cost of the first landline is not deductible, but subsequent landlines are. Insurance. A lot of businesses will take out some kind of insurance, whether it is workers' comp or just liability protection. So the cost of the business owner's health insurance, business continuation insurance, and the business owner's policy are all 100% deductible. Other types of deductible insurance policies include property insurance, malpractice insurance, liability coverage, workers' comp, as I said before, auto insurance, business provided employee life insurance, and business interruption services. Now, you have to note that with health insurance, a small business may also qualify for up to 50% in tax credit under something called a QSARA. We have an entire show dedicated to QSARA. It's a qualified small employer health reimbursement arrangement. Number 17, business property rent. If you rent your business property, you can deduct your lease or rental payments from taxes. Or if you run your business from home, you can also run an eligibility test with the IRS to see if you are entitled to any deductions. Right? Now, the types of deductible home business expenses include mortgage insurance, mortgage interest, utilities, home insurance, repairs, and depreciation. If you want to learn more about that, the IRS has a form called IRS Publication 587. If you go to www.irs.gov, you get all the info there around business property rent and depreciation on equipment and machinery. Now, if you lease equipment or machinery for a business, you can fully deduct this cost, right? This can be anything from copiers to printers to trucks and vans. You can also claim depreciation on equipment and machinery. However, the cost must be deducted over several years, right? And the useful life, that's how accountants call the the number of years over which you will use a machine or other kind of equipment. So the useful life can range from 5 to 20 years, right? So in order to do this, now you must claim something called Section 179. Section 179 allows business owners to deduct up to $1,020,000 from new or used property in service during the tax years. Office supplies, staples, pens, boxes, paper. They might be small, but they all cost money, so you can deduct them from your taxes. Office furniture, right? This is considered some kind of office supply and can therefore be deducted just as you would deduct printer paper or cleaning products. Employee benefits program. You can also deduct certain employee benefits program. I'm talking here about qualified retirement plan accounts, life insurance adoption assistance, dependent care assistance, or educational assistance. For self-employed individuals, contributions to their own retirement plans are personal deductions claimed on Form 1040, not through the business, but through their personal tax form 1040. All right. So this is it, folks. Really appreciate having you around here. So today we were talking about small business tax deduction you must absolutely know so you can stop sending free money to the IRS. Now, let's quickly do a recap here. So I talked to you about software subscription, auto expenses, advertising and marketing, business entertainment, bad debt, employee gifts, interest, startup and organizational cost, inventory, travel expenses, taxes, contracted labor, employee salary, legal and professional fees, utilities, insurance, business property rent, rent and depreciation on equipment and machinery, office supplies, office furniture, employee benefit program. Now, how to claim small business tax deduction. And this is kind of a pro tip here. To claim small business tax deductions as a sole proprietorship, you must fill out something called Schedule C tax form, and this is on your 1040. And this Schedule C form, it's used to determine the taxable profit in your business during the tax year. You then report this profit on your personal 1040 form and calculate the taxes due from there. Now, if you are a sole proprietors, if you are a business, you are an LLC, you are an S corp, a C corp, or a partnership, you calculate the amount of you do the deduction at the business level, and then based on the income or loss you have, that gets transferred to the individual members and owners' personal tax returns. This is for every kind of legal structure except the C corporation, where the company does everything, deducts everything, and pays taxes on the net income, on the taxable income at the company level, at the corporate level. All right. I will talk to you another time. Thanks so much for listening. Until next time, remember, stay marvelous.